Hi guys, I am Harshal and today we are going to discuss about some basic accounting concepts and terms which are following: income, expenses, profit and loss. These four terms we are going to discuss in this video. So let's start with income. Meaning of income. Income refers to the increases in economic benefits during an accounting period in the form of cash, asset increasing, liability decreasing. We have an example about income. Chintu is a fruit seller who sells fruits in the market. When customer buys fruits from Chintu, customers pays to the Chintu. So the amount received by Chintu is called Chintu's income. So here we have some more examples of income. Income from sales, rent received, interest received, commission received and dividend received. These are also examples of income. To the types of income. So first is revenue. Revenue is the income a business earns from its main business activities. Example, a shop selling products, a service company earning fees, schools tuition fees. These are common examples of income. Second type of income, which is gains. So the gains are different. This comes from side or incidental activities and increases in equity from a peripheral or non-recurring activities distinct from a company's primary operations. So the gains are not direct income which comes from its main operations. It's an income which comes from non-operational activities. An example of gain: profit from selling old equipments, interest earned on investments, foreign exchange gains. These are common examples. So let's move to the second concept, which is expenses. Meaning of expenses. Business expenses are the costs that companies incur to support their operations, including rent, payroll, inventory, insurance, travel, entertainment, business meals, and any other investments to keep organizations running. In short, expenses are the cost a business must pay to run and earn income. An example of expenses: Chintu and Pintu has a coffee shop. So for this coffee shop, they have to purchase material, gas, and has to pay electricity bill as well. Employee salary, as much investment they have to do, only then shop will run smoothly. So all this money spent by them, this is an example of expenses. In the bottom line, we have some extra examples of expenses: marketing expenses, material expenses, office and equipments, office supplies, and subscription. These are types of expenses. Moving to next. In business expenses, there are four types of expenses. First is fixed expenses, variable expenses, operating expenses, and non-operating expenses. So the first type, fixed expenses. Fixed expenses are also called cost of goods sold. These are the costs which are directly involved in producing a particular product. Example, raw material and wages. Moving to next, operating expenses. Operating expenses are the regular ongoing cost a business pays to run its daily operations, excluding the cost of production of goods and services. In operating expenses, there are two types of expenses. First is fixed expenses and second is variable. In fixed, there are many types of expenses. Here we have an example like monthly rent, and in variable cost we have for packaging cost and material. So here in the top right corner we have an example how expenses are calculated. So from revenue, we subtract expenses. In expenses, we have marketing expenses, rent expenses, salaries, utilities. These are once we combine this, we call it total expenses, and we subtract it from the revenue. After subtracting, we get net profit. Third type of expenses, non-operating expenses. Non-operating expenses are the costs that a company incurs not from its core business activities but from secondary or incidental activities. And examples: interest expenses on loans, losses from selling assets, foreign exchange losses, lawsuit or settlement cost, restructuring or one-time charges. And the last one is depreciation. Depreciation expenses is the portion of fixed assets cost that is allocated as an expenses for a given accounting period. In the other words, it represents how much of an asset's value is used up during that period as the asset helps generate revenue. Example: machinery's value at a time of purchase was 1 lakh rupees and after 1 year use of its value is 80,000. So the difference between the price by time is depreciation. Moving to third concept, profit. Profit is a what remains after subtracting all expenses from income. Profit is a financial gain a business or individual earns when the revenue is greater than the expenses. Formula: profit is always equal to revenue minus expenses. Here we have a small example to understand how we can calculate profit. So Chintu runs a small stationery shop. He buys a box of pen for 200 rupees and then he sells the same box of pens for 270 rupees. So now we can calculate the profit using the formula. So profit is equal to 270 minus 200 is 17 rupees. So in this whole transaction, the 17 rupees, the extra money charged by the Chintu is profit. Next, moving to types of profit. First is gross profit. Gross profit is the amount of money left after deducting cost of goods sold from the sales. So here we have formula. Sales is minus to cost of goods sold and then we will get gross profit. So here we have an example. Chintu buys an item for 300 rupees and then sold it to 500 rupees. So in this transaction, gross profit is equal to 500 rupees minus 300 rupees is 200 rupees. So that 200 rupees amount is gross profit. Next, operating profit is also earning before interest and tax. Operating profit, also called operating income or EBIT, is a company's profit from its core business operations before deducting interest and taxes. Formula: operating profit, gross profit minus operating expenses. So here we have an example. Gross profit is 30,000 rupees and 10,000 rupees operating expenses. So the operating profit is 20,000 rupees. And last is net profit. Net profit is the amount of money a business has left after subtracting all its expenses from its total revenue. Here an formula. Net profit is equal to total revenue minus total expenses. So expenses includes cost of goods sold, operating expenses, interest, tax, depreciation and amortizations. So these are all expenses. Once we exclude subtract it and then we get net profit. And the last concept is loss. Meaning of loss: when company's total expenses are greater than its revenue over a specific period, resulting in a negative financial outcome. An example to understand how loss we can calculate: if a Chintu is spending 50,000 rupees per month on a coffee shop and in return he is only getting 40,000 rupees, then we can say Chintu is in 10,000 rupees loss. Let's move to types of losses. First is operating loss. Operational loss refers to a financial loss resulting from failure in a company's internal process, people, system, or from external events. Its key concept in risk management. Common sources of operation losses. First is process failure, second is human errors, and third is system failure. So here we have two examples of operational losses. First is a bank loses money due to a system glitch that processes transactions incorrectly. And second example is production downtime caused by equipment breakdowns. Second type of loss is net loss. When the final result after deducting all expenses and interest, taxes is in negative. Third type, inventory loss due to theft, spoilage or damage. Bad debts, when customers do not pay what they owe. And last one is capital loss, when the business sells an asset for less than its value. So let's end the video here. Thank you for watching.